So I'm gonna do all electronic trading hours just because within the server, people are trading every session. We stream Monday through Friday, New York, and New York AM session and New York PM session, of course. And then Tuesday through Thursday, we also stream London. And then as soon as the market opens at 6 p.m. Eastern Standard Time every single day, people are also usually streaming, or sorry, not streaming, but trading Asia. So I'm not going to restrict it to regular trading hours or kill zones or anything like that. We're just going to go ahead and do everything. And again, this is a very basic chart exercise. So the week is starting here. And what we're going to be doing together, or establishing together, is basically when to measure dealing range and how to measure them. And I think we'll basically see a recurring phenomenon. Okay, so usually what I do while price is printing in real time is I'll just have my fib on as the dealing range prints. So see here already, just in 1, 2, 3, 4, 5 candles as the market opens, we've created a range. And the reason I can say we created a range is because we have a swing high here, and now we have a swing low. Now this is the thing about what we're seeing, is that on this third candle, we've already retraced to premium. Usually I want to see, once a swing low is created, or once a swing high is created, I want to see the fourth candle trade through that third candle. And the preference is to close above. So in this instance, we've opened, we've created a range, we've returned to premium. So let's just continue to see what happens. So now we definitely close above this first candle. Now all that means to me is that a range has been established and we can now draw premium to discount. And once that low has been established, we can definitely see, the other side of the range. However, in this instance, again, the third candle did already retrace into premium. Okay, so again, as price just prints, I'll keep this dealing range up until it's invalidated or until we create a new range. So no close above currently here. All right, so now that we've broken structure, I will now start to monitor this new dealing range being created. So again, as price prints in real time, I just continue to drag my fib up. All right, so now that we have a swing high established, we haven't closed through them, but it looks like it's going to. We did create a new high before trading lower, so we could potentially have another swing high being created here. Okay, great. So now in the new swing high that's created, and just in case, someone here doesn't know it, a swing high is a candle with a high with a lower high to the left and a lower high to the right. Vice versa, a swing low is a candle with the lowest low in the middle, higher right to the left, higher right to the right. Higher low to the right. We have now put in a swing high. Once a swing high is established, that is when I can assume or anticipate that equilibrium can be retraced to. Okay, so again, this is a chart exercise for all of us to kind of experience together, but this is how I view it. We have a swing low, we've broken structure, we have a new range to measure, and now we have a swing high. Once that swing high is put in, it is probable that we will return to equilibrium. And so now what does that mean in real markets? That means that, if you're waiting for a setup, if you think you've lost this move, or you want to participate and you don't know when to get in, well, you can simply wait until equilibrium is retraced to. And when will equilibrium be retraced to? Well, when you have a swing high or swing low established. Okay, so let's just play this forward to see if we actually do get into discount here, and so far this is holding. Once we break the high, or if we continue to break highs, then we simply drag our premium discount tool. All right, so we did not retrace to premium. We did not retrace the discount. So now I just drag my tool up. All right, so we obviously have a swing high established here. Visualize here that we haven't broken the range yet. All right, continue to move forward. What I'm trying to exemplify here in today's exercise is how to anticipate when price can retrace into discount or into premium, when it can retrace into 50%, and how often it happens, basically, right? So I'm just showing people how to measure the range, basically. So as the range keeps printing in real time, I'm following the range with my fib, and then we can anticipate 50% once swings are basically put in, right? Now obviously we can jump into the higher time frame, and here on the 5-minute, no swing high, this one right here, it retraced back into order flow, but it didn't go back into discount. So we create a swing high, we retrace lower, but it never gets back into discount of this entire range. Well, at that time here, it never retraces into discount. Order flow here is holding, right? So what we're seeing on the 1 minute is there's going to be a lot more swings being put in, as opposed to what's happening on the higher time frame. But the purpose of the exercise is to, again, exemplify just how often it does return to discount, which basically should translate into, a move is always coming, basically. A move is always right around the corner. So there's no reason to FOMO for today's trade, or this session's trade, or this moment's trade. There's one always right around the corner. All right, so now we've reached discount. So in all this time printing, we just missed it. Let's see if the next one gets it. There we go. I don't know how that moved there. Okay, so again, price continues to go up, right? We just follow the range as it's printing. Once that swing high is established, it can retrace at any moment. Swing high is established on these 3 candles. We trade through the low of one of those 3 candles, or we close below one of those 3 candles here. On this candle, it makes it a high probability that we will likely return into discount. Okay, so now Tony Hu, I'm assuming that doesn't say Ho. My bread and butter model is 2022. I use a 5-minute 2022 model. I'm a very basic ICT student. So from here, we created a range, we returned into discount. At this point, the equilibrium is plenty, right? And I'm just going to take it a step further here, and I'm going to show OTE. 50%, 62.7005.79. All right, so OTE is anywhere within this range. OTE is not 62. That's usually people get that incorrect. 62% retracement is like a universal retracement across the entire trading industry. The percentage that made ICT famous, OTE, is actually 0.705, but this entire area is like what we call the OTE zone, I guess you could say. So how can you utilize this in live markets, right? Well, once you have a swing high established, even on the 1-minute chart, you can anticipate that retracement retracement into discount, it's on its way. Obviously, we put in a swing high here, and you had to wait from here all the way to here. I don't know, let's see. 820. to 20, so about an hour and a half. And so in that hour and a half, you had to wait for price to come to discount. I don't think that that's, too long, in my opinion. I'm not a scalper for the record, but once the swing high is established, you basically can just wait for the retracement to come. Now this is where you can start to build on this idea. Now that a swing high has been established on either the 1 minute or the 5 minute. Let's say you're watching the 1 minute, but you're waiting for the confirmation on the 5 minute, for example. Once you have this confirmation here, 2025. So once this candle closed on 2020, it would have been 2025, so it closed at 2030. So once you have this candle close here, the next candle on any retracement, which you do have a retracement, both here and here. Let's just zoom into this area. We retrace into the last up close candle. We put in a high, and then this high gets taken out. Right, so you can, if you want to be JD, if you want to have a flashy entry, not that JD is flashy, sorry, I don't mean to intend that, but if you want to have the very best entry you can possibly have, you can soup the high. Or simply, you can wait until, we obviously retraced into these volume imbalances. Choose your poison, whatever it is you want to use as confluence for means as an entry. Or you can wait for the old reliable, this inversion. Right, you can get an entry there, another tap there, this place is lower. Or, you can wait for fair value gaps to be printed in general, right? So there is a tiny fair value gap here. There is a fair value gap there. This one obviously stays open. This one stays open. And what do open fair value gaps mean? It means speed, right? So if they never get retraced into, that's actually a good thing in your favor. So once that swing high is established, if you wanted to trade counter to your dealing range and you wanted to just get in a quick trade, you can take this into discount. If you think that the overall trend is actually bullish, and which in this actual framework, since we shifted structure here and we're trading higher, this current trend, this immediate trend is bullish, right? This immediate price leg that we're trading in is bullish. So if you wanted to, in fact, just wait until we get to discount and then wait for a swing low to form, then take it in the bullish direction, that is 100% an option too, right? So you can trade counter trend or you can trade pro trend using simple tool, premium and discount. Do you use opening ranges for confluence? Where it's at right now is the break of Tokyo open range, so the break and then target 50%. So where we are in price action is not according to my strategy at all. This is just I'm testing the last week of price action. No intention behind it except for that I'm not cherry picking price action. I'm literally just going over the last week. I'm starting from the beginning of the week and going through all the price action, not cherry picking anything. For me, the hardest is to be able to build a narrative and a reasonable target then from there the entry model is easy. Right, so that's exactly the point of the exercise, Jess, is that the narrative right now, right, is we opened, Asia open, we traded lower, we broke structure higher, and it's continuing to trade higher, right? Now at this point, again, once we put in that swing high, that's when you can assume that, or anticipate, let's use the word anticipate, that's when you can anticipate that discount can be retraced to. So once that swing high is put in, and again, we're watching the 1 minute because we normally are trading the 1 minute throughout the day, but you can also utilize your higher time frames for this, obviously, to not get caught up in the noise on the lower time frames. And you can wait until your 3 candle swing high is closed below. So this is the highest swing high here. We want any one of these candles to be closed below. The first one that's closed below is this middle one. The lowest one for safety is this one here, right? So it's closed below there. Once this is closed below, on the 1 minute, you can feel safer to take that entry. So the narrative is that we've created a range and you can trade it back to discount, or once that range is created and you can, a swing high is put in, you can easily take that trade to discount, or you can wait until a swing forms in discount to continue to trade higher. So the overall concept of a trend, and that's what I'm saying, Josh, is like, you don't need crazy, like, you can overlap as many time frames as you want. You can do a weekly outlook, you can consider news, you consider the opening range, you can consider Hong Kong gaps, whatever, pick your poison, pick anything you want, pick a range, any range. That's what I'm trying to exemplify. You have a dealing range, all you need is a simple fib tool, premium and discount, and you can build an entire narrative with just that concept alone. So you have a range. When can you expect discount? Now, once a swing is put in, once that swing is, or premium or discount or equilibrium, when can you expect equilibrium? Once that range is put in, you can take a scalp into that equilibrium, or you can wait for a swing to form or an entry to form in discount to trade to premium, or in premium to trade to discount, right? Now here, we're gonna get into a little bit more advanced theories once we start to trade into this area. But here, right, because we have traded higher, because we've broken structure higher, literally just on the 1 minute time frame, right? We have a range and we've traded into discount. We're not actually anticipating that we're going to trade to the other side of the range. This is low probability, actually, or it's lower probability than trading into equilibrium. As an ICT student, I personally believe that there's an algorithm that runs the markets. You don't have to agree with this concept, but because there's an algorithm, because I believe that there's an algorithm running the markets, then I believe that the market runs efficiently, and as a means of running efficiently, it has to rebalance inefficiencies. What is an inefficiency? In layman's term, it's in the most popular term that everyone knows, it's simply a fair value gap, or any volume imbalance, any of these opening gaps, any kind of gap, right? So wherever there's an inefficiency, the market will trade back there to rebalance it. So just in this current frame of work, we've broken structure higher here. We're trading higher. We're not expecting the opposite end of the range, because that would indicate to us that we are consolidating. In these markets, they actually trend higher more than they consolidate. So we actually assume that you have a low, a high put in. You would expect a higher low to put in, and then you're expecting actually this to break high for the most part. Assuming that, I would say personally, trend days are the easiest days to trade. This can be according to what you've learned personally, but it's easier. It's, the trend is your friend, I think is, a very popular term. I do actually think that that's easier to catch. A continuation is easier to catch than a reversal. Unless you are like me, that like to be a contrarian and short every tick until the account's won. Yeah, so that's why, Jess, a very easy narrative is simply just knowing your dealing range, right? So like, instead of trying to short it or short every single trend, you can simply short it into equilibrium. Even if, like, you guys have actually seen me do this on stream multiple times. My very first streaming New York, actually, I watched a long printout. I think it was like 100 points, and I sat there on my hands because I'm notoriously a shorter, right? And as soon as that swing high was printed in and was established and confirmed, I entered that short and I took it to equilibrium. Okay, so this is, again, like, even when the market is trading up, you can trade counter trend as much as you want, but you have to get out of that move, and you have to have the understanding that you are trading against the trend. This is not a home run, right? So if you decide you're going to be trading against the trend, you understand that this is more than likely a scalp. This trade is short-lived. If you hold too long, you are begging to get wrecked. Okay, and I've actually traded counter trend in live stream many times, and that exact example has happened many times, where I've sat on my hands. I say, no, I'm interested in shorts today because I think the shorts are going to be home run, or I think that we're overall short for the longer term. So because of that, sometimes I'm wrong on my bias, of course. And if you think of the word bias, or you think of the connotation of bias, it usually holds a negative connotation, does it not? Normally, when someone asks you, what do you think, this or that, you say, well, I'm biased towards this, right? And you're usually indicating that as a handicap. So just consider that. And JD has actually taught us that, the reason he goes into the day with the general idea of, if this, then that, right? And he has multiple ideas laid out for bullish and bearish scenarios most of the time, using higher time frame PD arrays. And he takes the market 90 minutes at a time, because he learned about himself that when he's too married to a bias, or when he has a bias established, he would get too married to an idea and he would get wrecked. So he simply takes it 90 minutes at a time. I have 100% found value in that as someone who does use a bias, and I purposely go into the day with a bias so that I don't get wrecked. So I'm the exact opposite of that, exact concept. So for me, if I think that the higher time frame trend is bullish, I actually don't want to short into equilibrium, even though I'm notoriously known for shorting. I want to wait until we get to equilibrium, and then I want to see a trade form in this area in discount, and then take that trade higher. Why? Because when we're trading higher, the market looks like this. We're establishing new highs, retracing to equilibrium, establishing new highs, right? And obviously this is a crude depiction, but this is the general idea of a market trending higher, right? And if we're consolidating, then you have something that looks more like a market maker sell model, or a market maker model in general. You have price trading within one range. One range has been established, and actually this past week is a very good example of that, so we'll get a lot of that this week. But a high and low is established, and it can look like anything, but you're still trading within this exact range. You trade higher, you take out highs, but you still kind of remain in the same exact range. That is consolidation. Okay, so this would be the first dealing range that was established, and you're just staying within that range. This entire thing is consolidation. I personally do not try to participate in this type of price action, although you can. And JD proves that every single day in the markets, on our live streams. He shows you how to trade, every 90 minutes. You can take a trade every single 90 minutes. So now, Joss, going back, you can take your short as much as you want, but you have to understand that you are, against the trend if we are in fact trending higher. So just for kicks and giggles here, how much could you have gotten out of this move in which we established a 5-minute swing high, and we're retracing to our dealing range of, equilibrium, or our equilibrium of our current dealing range? Let's say we use the most basic ICT setup here, or we use the most basic entry of fair value gap. The fair value gap that gets retraced into is this one. It well exceeds it, right? So I'll just use the low of that fair value gap, and we'll go into equilibrium. That was 36 points at one contract. That is $720. Are you upset with that? $720 in 25 minutes. Okay, so that is how you can trade counter trend if you want. So now, how do we know if equilibrium is going to hold, or it's going to trade to the other side? How do we know that we're going to trade to the other end? The easy answer is we don't. Right? So that's why equilibrium is such a gem, because you can simply use equilibrium as your target or where you're going to trade out from. Personally, I find, for my own psychology, this is not for anyone else, but personally what I find is that I like to trade the external ranges to the internal ranges, simply because this is more reliable, in my opinion, to me, or has been more reliable for me. And that's because, again, you'll see as we go through more price action, but equilibrium is pretty reliable, right? Normally when people try to trade from equilibrium to external range, what happens is that they're impatient, waiting for an entry to actually form. And what they end up doing is, in this case, since we're retracing bearishly, they'll catch a falling knife, right? So what they'll do is they'll start buying here as it's dropping without a swing low actually forming in their favor. Okay, so like here we rejected once equilibrium, or we missed it and traded up. We came back into equilibrium and we're only wicking it. We're not placing any bodies through it, right? So a very aggressive trader will start to buy at equilibrium, thinking that, this thing is going to move. I don't want to miss the move. So they'll start buying. What I actually personally do, and then what ends up happening is that it falls through them, or they've, entered here and now we've fallen, I don't know, we've fallen 16 points. So they're down $320. And they're like, oh no, maybe that account they've blown by then because they've over leveraged, or whatever the case may be. So they enter too prematurely and it ends up falling through their stop loss or falling through their entry, right? So what I actually do, if I'm trading from internal to external range because I want to catch the trend, I wait for that swing low to form or an entry model to form there. Obviously, an entry model is going to be stronger because you probably have multiple confluences building in your favor. But I simply wait for that swing low to be established. Once that swing low is established, that's when I can anticipate that, I may want to start looking for an opportunity to get in here. Now, that's one advanced thought, or, just one more step or puzzle piece to this. However, I will also touch on something else, another ICT concept, and that is the concept of institutional swing points. What an institutional swing point is simply a fancy word for two swing points, essentially, right? Or at least two swing points. So we're on the 1 minute time frame. Don't forget, never, although the 1 minute you can trade on its own, I do believe that. I do think that utilizing multiple time frames is going to be in your favor, but institutional swing points simply consist of either a breaker forming, which is a run on stops, or it's a failure swing forming, right? And the concept of this, again, is that in one, you have a run on stops. One concept, you have a run on stops. In the next concept, you have a failure swing, which is a form of manipulation in the fact that usually people are thinking this is going to get ran. So the concept of a institutional swing point is that you either want a low to be taken out, or you want a higher swing low to be formed and, traded through, right? And what is this when you see either, right? Well, if you see either, it's usually one is occurring on one asset and the other is occurring on another asset, and there we have the concept of SMT. Now, this is not a part of today's lesson. This is just to take, how swing lows form to another level. but essentially you're gonna I wait for this institutional swing point to form. Once an institutional swing point forms, and sometimes, you know, I miss a lot of trades, but once that institutional swing point forms, I refer to another asset to see if there's possibly SMT within this institutional swing point as well. So I say that to say that once the swing low forms here, I'm actually not pulling the trigger just yet. I'm waiting to see, do we form a higher swing low, or do we take out the swing low first? Because here we did tap OTE, right? So if I am waiting, if I think, you know, NASDAQ is heavier than ES, and I think, you know, we're going to take the low one more time. We've also created all these failure swings right here. This is just begging to get ran, you know, very all discretionary ideas, no statistics behind it. But if I think we're going to take this low, what I want is to see something like this form, you know, deeper retracement and then trade higher. So moving down to the next Fibonacci level, or it can even trade, you know, lower than that, right? It can continue to trade lower. I could be wrong that we're moving higher, and it'll start to, for lack of better terms, it'll start to flip these areas and use them as resistance and trade lower. Okay. Now, the other thing that can happen is that we can trade to the next Fibonacci level, equilibrium, establish order flow or swing low, and then we can trade higher. Okay, so we'll see what happens here. I'm not pulling the trigger on the first swing that forms. I want to see another swing of any kind form as well. So, you know, there we go. That swing low is now taken out. Once this swing low is taken out, then it's like, okay, great. Now I can in fact wait for an entry. And what do we see here? We possibly see an inversion, or we do see an inversion confirmed. We close above this fair value gap on the next candle. We want to ideally see it displaced through the high, respecting this inversion. If we see an immediate invalidation, we know to wait. All right, so we closed above, didn't quite displace through. Great, now we have some displacement through previous candles. We've at least closed above previous high candles, or previous candle highs. We do want to see this form as well, or we anticipate that this will be broken through. Notice here we don't actually retrace into this fair value gap, but we do get that retap of that inversion. So let me just zoom in here for everyone to see. And again, this is not the focus of today's back test. It's actually just dealing ranges, premium and discount, OTE. But just to show you, we did in fact get, even after this candle closed above it, we get that retap right there. And look at that, it's right at the CE of the fair value gap. That is an entry, that is a viable entry that anyone could take. It's an entry that we take very often here within Kingline. And we can see, does it actually start to trade higher? So again, it trades lower once more. So a low is, we take out the low, we trade higher, we run buy stops. Now, what is the sign that, what is a clue that we can gather from this to think, oh wait, it's not ready to go yet? It misses the next Fibonacci level, it misses equilibrium once, twice, 3 times, 4, 5, 6, right? So here I'm not counting candles, but there's no follow through once we break structure. We retrace into this fair value gap, and again, what did I say when we retrace into this inversion? Well, when we retrace to this inversion, we want to see displacement up, right? It did displace up here. Now we printed a new fair value gap. Did it displace up? Well, we do have another confirmation, but no displacement. So we want to wait for more data. It closes lower. Not good for us. We don't want to see this happen. It closes lower. We actually, no worries. We don't want to, you know, this is not what we want to see. it gets our hopes up again. It prints higher, but again, no displacement yet, right? So it's not looking good just in the framework of these six candles. So as more data is being presented to you, you're kind of understanding when your idea can fail, or when it becomes higher probability that it's going to fail. So we then print another candle, and now it's like, okay, we are trading higher, but again, still no displacement above highs, right? We do close above our previous candle high, but still no displacement through a swing high, and again, another down close candle. Up close candle. Now here, you are seeing a fair value gap print against you. So these are just all clues in which maybe this is not it. Maybe you want to trail your stop to break even now, or just cut the trade there altogether. You're likely break even around here. Okay, so as we trade lower here, we've closed all the way through this OTE area, right? So what did I mention here is that now we can start to, like, if we think, or how do we know we're going to trade to the other end of the range? Well, it's when we start to, again, for lack of better terms, flip these areas and start to use them as resistance. So we've closed through all of this. This is kind of, this last down close candle here would be kind of my last line in the sand. If I wanted to allow this idea a lot of leniency, then the CE of this wick here, this bottom wick, would be the very last chance for longs to occur. Obviously this is pretty late, but here, since we've already shifted structure up here, continuing to break structure lower, and now we've run buy stops and then also broken lower. I think here at this point, just even here, like as it fails there, it starts to become higher probability that we're going to trade through here. Once we've closed through 62.705, 0.79, I think that's a pretty good, those are all pretty good clues that you're probably going to see the other side of that range. All right, so again, we trade up into this level, we miss it. This fair value gap does in fact hold price down. It's resisting it, and then it trades lower. Let's see if we actually make it. There we go. So the other side of the range is in fact seen here. Okay, so this entire thing, consolidation, we've created one range, we traded back into that range. All right, and now what is happening on a higher time frame scale is we've ran sell stops here. We wicked this low. It appears here that it's trading higher. We'll see what that looks like on the 5-minute. So we've created a range, traded lower, it took out this low. Okay, now again, Jess, going back to always wanting to short the markets. If you think that shorts are the home run, and I always think shorts are the home run, and it's only because we're always trading higher. And so, since we're always trading higher, a deep correction could pretty much always be on my radar. And because a correction can always be on the radar, it's like if I just catch the right short, which is actually the wrong mentality, but if you catch the right short, it can turn into a home run. I'm not in the business personally of turning scalps into home runs. I keep in mind that I am trading counter trend according to the current market structure, right? So I would personally either TP or take partials here, or again, if you believe that you have the home run, then I would simply just trail my stops at swing highs. So every time you close through up close candles on a trend lower, I would trail my stop to that swing high. Now I actually opt to trail my stop by 2 swing highs, because you always have the probability of inducement. So, or let me just even use this one here. So an up close candle is formed, we trade higher. If I were to put my stop at this high after we close below it, then I would be induced. It would stop me out, break even, let's say, or in profit, and then it would continue to run without me. So I choose to trail it 2 swings back. All right, so continuing forward here. Does anyone have any questions so far? We have a new dealing range here. So now we have a high and a new low. This is the range that we're currently in. And again, as price prints, I'm just simply dragging my fib along. All right, so we do trade higher. Let's see if this is inducement or if it continues to this place upward. All right, continuing higher, continuing higher. So now that we're within this dealing range here, right, and we're trading back in the range, I actually do draw a second fib for this price leg to follow, you know, what it's doing. When can we return into discount? If I think, like, once we've broken structure here and I know that this is possibly going to continue higher, how can I get into this price leg higher if I think we're going to see equilibrium or this part of the range? Well, just here we have the swing low established because one of the 3 candles that create the swing low is traded above. Then we have the market structure shift to add to that. Then, you know, now I can anticipate that this equilibrium can be retraced to. And now that I know that this equilibrium can be retraced to, I can either look for a discount with, you know, obviously without the discount being retraced to, or I can follow this dealing range until equilibrium is retraced to. So following just these highs, we see that we did not actually get any retracements into discount before trading probably into equilibrium. Missed it. Drag it to this high. So equilibrium is tagged now. This is our you know, the current range that we're trading into. Again, going back to the very first thing I went over as we started the session for everyone that just joined. How I look at dealing ranges is I'm looking for a swing high and a swing low to be formed. Once both ends are formed, then I can anticipate that equilibrium can be retraced to. And that's within a premium, or that's with, you know, whether we're trading bullishly or bearishly. So going back to the first example here, this was the range. As soon as we opened, we traded higher once the swing high was put in. And for me, a swing high is established once one of the 3 candles is traded through. Okay, so we can print swing highs, yes, but are they established? Meaning, you know, can we trade lower from that swing high? I would want to see the 4th candle close below that, one of those 3 candles in that swing high. Preferably the entire swing high all at once, but once we have that 4th candle closure, it becomes more probable that we can retrace to equilibrium. So once we created this new range here, in which we took out this low, this is our new dealing range. When can I anticipate that equilibrium be retraced to? Well, when a swing low is created and displaced through, right? So again, just to see what this looks like on the 5-minute chart, all of those lower time frame 1-minute swings that we're forming were never actually traded through on the 5-minute chart. So all of these little movements here, well, we have this swing low formed. The highest point of that swing low was traded through on this candle. Once we take out that swing high, there's no displacement after that, we trade lower. Are you guys seeing a recurring phenomenon yet? All right, so there's no follow through after the displacement. We close above it. I can anticipate that we can probably see equilibrium. Another swing forms down here. The highest point of this swing low, these 3 candles, is just about there. We close above it there on this candle. And once we close above it, there's no displacement higher, no new highs, right? So again, it runs the low one more time. Then finally, we create another swing low. The highest point is closed above there. From there, we have a fair value gap as well that has, or sorry, on the next candle, when that prints, we have a fair value gap now established that's left open. The next candle prints, it breaks structure here, another fair value gap is printed. Okay, so once this swing low is put in, I want to see displacement and follow through. I want to start to create new highs, and that can confirm to me that we're going to equilibrium. So now we're at equilibrium. So in this, and we're not going to use like any higher time frame context for this. We're simply going to be operating from the 1 minute chart. But here we're trading into equilibrium. Now this is the clue that I'm personally going to use here. Did we close below this low? No, we did not. So because we did not close below this low, I am still actually of the frame of mind that we will likely continue higher, because we just simply came back to run sell stops. So once we get to equilibrium of our range, what I want to see to prove that I'm right, or not to prove that I'm right, but to indicate to me that we will trade higher, is I want to see levels act as support and resistance, for lack of better terms, right? So just for very, very basic idea, what I can do at this point, instead of only using premium and discount, you can change this into quarters, where you have 25, 50, 75 also delineated here. And another step in building your narrative can be, okay, we've traded up to 25% of the range, we've established order flow here, we've printed down closed candles, we've run sell stops. Do we trade higher? In fact, we do trade higher. Once we trade higher, the very next level I want to see is whatever your next bid level is for equilibrium. Once we get to equilibrium, I want to see order flow or a run on sell stops. Once we get that run on sell stops, I would like to see us continue to break higher. And what does it do in this instance? It gets into equilibrium, it gets into premium, and it actually breaks structure lower. It respects fair value and displaces lower again. So are we just retracing into equilibrium of this leg? So let me pull that back. So once this swing high is established here, let's see what that looks like on the 5 minute. Swing high established here. The lowest point happens to line up with where your market structure shift would be. We get a close through the swing point on this candle. Sorry, this candle here. This does also, let me just confirm. Yep, so this does also break structure here. So then we can assume that equilibrium will be retraced to. If we do continue higher, again, what I want to see is equilibrium hold, or 25% of this range hold. Equilibrium, low taken out. Seemingly, so far, equilibrium is holding, right? 25% traded through, seemingly holding so far. So just in knowing what range you're dealing in, you have a narrative in price. All right, so no willingness to stay in premium. It's continuing to dive down into discount. We've now at this point traded below equilibrium. And let's pull up the quarters of this one here. We're now in the bottom 25%. Now, the bottom 25% of any range is also OTE, optimal trade entry zone, but 62.705 and 0.79. So the bottom quarter falls within your optimal trade entry area, right? So swing low is formed, it trades higher to the next bearish array, it runs buy stops, and from there it's continuing to displace lower. So seemingly now it looks like the trend is currently bearish. We're breaking lows now. So now this instance we ran sell stops, traded into equilibrium, broke lower. Let's go back here. We have a dealing range within a dealing range, and then from there we trade into equilibrium. Once we get to equilibrium, again, what I wanted to see is displacement above, and I want to start to see these areas used as support. We get to this area and in fact acts as resistance. It trades lower. Once we get into this area here, or again, what I would like to see, what I would have wanted to see if my idea of higher prices was correct, or would indicate to me higher prices would be printed, I would want to see these areas hold, right? These discount areas hold to send price higher. They do not, they start breaking. We'll quarter this fib up. We get into equilibrium. We miss the upper 25% quartile, so 75%, and we in fact displace lower into 25%. And now here I'm going to follow this range. So no retracement into premium so far. So no retracement into EQ, no retracement into EQ, no retracement into EQ. Boom, 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 nothing. Next low, nothing. Next low, nothing. Next one, still no retracement into EQ. Okay, so the retracement into EQ to move lower was this move here, and as we trade into these levels here, again, we just simply see them acting as resistance as opposed to acting as support. So all clues that we're starting to trade lower, or we are trading lower, and it's not, we're not expecting to see the other end of the range now, because we're failing to trade higher, and we're now using these premium areas and flipping them. Okay, we have this range, we retraced to EQ, we followed this range all the way up. There was no retracement into EQ to get to this equilibrium, and this leg down to see the other side of the range, we saw no retracement into equilibrium. This was the only retracement here. We did close below this low now, and we have a new range established. We will follow this one down, low here. All right, so we do have a shift there. We want to see, does it give us the market structure shift, or sorry, does it continue to break swing highs? That would be the next level I want to see. We did shift structure here at that swing high. That's the doji. Okay, this is the lowest low. This is the down close candle before that. Fractally, once we trade above there, that's good enough. I personally like to see the swing high, if there is one, coupled with a down close candle. Once we close above that, we've shifted structure. I want to see now, do we continue to break highs? Usually a more conservative trader, once a swing low is put in, a conservative trader will wait until you have a second high being broken, essentially. So any one of these highs, we break through that, and then they wait as well for a higher low to be put in. Once this higher low is established, then we are looking for an entry in this price leg here. Okay, a aggressive trader thinking that every trade is a reversal or an opportunity to scalp some points will actually be looking for a trade here once we've broken structure. So once we have that new high put in, they'll try to get in as soon as possible. Or if they do wait for that second high to be broken, they're trying to actually get in here, as opposed to like getting in this price leg, one like in this low, as opposed to waiting until price displaces higher and trying to get in, you know, somewhere once price is actually trading higher. Going back to the idea that when you are trading through equilibrium, or you're trading internal to external range, I find that trading external to internal is easier because equilibrium is very reliable, as opposed to if I were trading internal to external, I would have placed an entry at equilibrium at any one of the OTE areas in here, and then try to just trade to this external range. But again, we don't actually know if we're right about the trend or not, or if we have a good read on price to say, you know, we are going to trade higher. They will try to trade internal to external. Their entries will get ran through before it actually displaces higher, and then you know, before they actually see the opposite end of the range before they actually do. So I find this trade here, external to internal, to be more reliable than internal to external. And then this is also a good example here. Once we had our dealing range established within this leg, move this over, this trade here was more reliable, or was reliable to trade to equilibrium. And then we'll see how this one pans out. This did obviously trade into the opposite end of the range. We definitely met EQ though, right, of this range. So we were tracing to equilibrium, couldn't displace above, you know, highs, and we continued to break lower. So now we're just going to see, do we continue to break highs or not? All right, so we're breaking highs. We're within this dealing range here now. Are we going to trade higher? We established the swing low. Once we establish the swing low, equilibrium is high probability, or it's probable in general. And again, if you, so there's EQ there. Again, once you like, because if you're like me and you like to take that external to internal range, once we get to EQ, that's plenty. We probably harvested a good amount of points there. In London session here, this would have been about 40 points ish, right, if we opted to trade the external to internal. Or, you know, if we believe these were all run-on stops because we displaced below the low once, we just wicked it, displaced higher, we close below here now, and then we displace higher once more. So it's not staying below lows once we take them out. On a much, where would I like to add here? If I were to get in this trade, so the first entry for me on this trade, I would have definitely been watching this inversion for the confirmation first. Then from there, it can be every up close or every down close candle, and then every fair value gap if I were being aggressive about adding. So once this confirmation was made here, when we actually started closing above swing highs, I personally, to be honest with you, I actually would have waited for this to add on, because anything in here is the aggressive entry, and I'm waiting to see at this point, do we close above this high? If we did not, if we started wicking in this area, we started to wick here, let's say we wick there, wick there, wick there, I would be more cautious and I would start to take partials, because this can be that run on buy stops if it doesn't turn into a complete break of structure again. But once we get here and we are holding, we're printing down close candles now and displacing up, this is where I would have tried to add on 100%. and then, EQ. Now, what is one of the clues that we are displacing through EQ? And EQ is not going to hold. So going back to this very first example, we established fair value at that EQ. We retraced into it, and that held. EQ of this range here, it acted as resistance. We did print fair value here. It's very minimal. It's not as obvious, but we run buy stops beforehand, and then we have speed back down through equilibrium. Of course, it trades higher one more time. When we trade through it again, that signature is there, although very nominal or very minimal. You have a fair value gap there as well. Printing through this equilibrium. So you have fair value being printed through that. So just speed, right? Fair value is essentially denoting speed. Right on, and add up to 50%. Yeah, Soy, I think you do the same thing, right? So like if I'm anticipating a market maker buy model or sell model to form, and I think we're going to see the opposite end of the range, yeah, I would add on as much as possible until we get to the other end of the range. And by that, I mean that if I were to enter here, I know that as I add on, my average would start to move up. And so I would honestly add on until EQ. Once we get to EQ, it becomes no man's land, because again, your EQ, like it could just get here, it could get to 75 even and start to break lower. So once it gets to here, you've reached premium, and that's when longs become a lot less probable and higher risk. So this is obviously a good sign. We see displacement rate. Yeah, exactly. Once you're confident, like once we've broken that second low or second high, to me, that's when it's like, okay, I think we're good. And then this is a common signature. We print order flow above that swing high, right? Essentially, like on a fractal form, even though there's no like obvious swing low here, this low doesn't print, into this fair value gap. This fair value gap is actually staying open. That is a sign that you have a tiger by the tail, quote unquote, says ICT. So that fair value gap is left open. We are establishing order flow above that, and we trade higher, right? So once we start to print swing lows above swing highs or order flow above swing highs, then I'm more confident. I'll add on, and I'll add on until EQ. Once EQ is reached, and I think we're going to see the other end of the range, I'll stop adding on. Now, this displacement through equilibrium is a good sign for us. It looks like we're going to possibly see the other end of the range here, but just using your external to internal, you did get this external to equilibrium trade printed. You did get this reliable trade printed, and again, that was about 40 points. Let's say you went from like the very earliest entry. Yeah, Q3 is 245 actually before London starts, so it's actually around here. Oh, you were right. Yep, right in Q3. Sorry, I don't know why I thought it was 245. I think because the 345. Yeah, sorry, my math is wrong there. So yep, you're right. So Q3 inversion. And for those of you who may not be in the server, this is essentially the Kingline model that we all trade on a very daily basis every 90 minutes. We have Asia range consolidation beforehand, right? We established that because we created a low, a high, we traded back within that range. Consolidation. We have a London low during Q3. Pretty textbook stuff. Q3 forms here. We trade higher. We can add on into here. Are we going to see the opposite end of the range? So far, displacement through EQ, continuing to break highs. We want to see this next level on the fib traded to and acted as support, again, for lack of better terms, or to be flipped, or just simply for swing highs to have swing lows or order flow printed above. Also, we want to see bullish arrays hold if we want to see the other end of the range. And continuing with today's theme, we will wait to see if equilibrium gets retraded to or retraced to in any of these areas. So high, 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 high. This is the current highest swing high. Let's see if it gives us another opportunity to hop into this long if in fact this has more room to go. We would want to see retracement into equilibrium. What happens to be around equilibrium? Order flow. Pretty good sign that we might get it. And no, it continues to trade higher. So we just keep following the range. And we do in fact see the opposite end of that range. So imagine, you know, from the beginning when we broke structure here, we established that the trend is, or just in the current price action without using any other time frames, we're going higher, right? Here we still wanted higher because we only ran stops, we didn't close below it. It got to EQ and then it traded lower. When we got to that low once again, we couldn't displace above it. This is another clue that the trend is actually bullish and not bearish in this current price action that we're seeing. And so once we break structure here, once you get to this point, we had this displacement through equilibrium. We wanted these areas to be used as support, or we want swing highs to be used as support. Of course, we would have loved that retracement into equilibrium if we could get it. What ends up happening is EQ of your overall dealing range at this point in time ends up holding along with the fair value that's in this area, and it displaces higher. Yeah, true. Let's throw on midnight. It's right here. It's probably around EQ. Oh, it's in premium. Okay, open there. Oh, great. So that was our target. So that was midnight there. Let me see if I still have a template for this. I do not. Okay. So there goes midnight, right? And the other side of that range. So, you know, adding on more, we have that Asia range consolidation. We have that London low. We've traded into discount, unable to stay into discount. We've traded into premium. We've traded above midnight. There is a whole narrative in just using premium and discount. And then you have other narratives that you could have added to that. Soy sauce just added in a bunch of time concepts for you. So we have that Q3. We have the session lows. We also have midnight, right? So very easy to, that would have been a way that you could have navigated price, right? So now we are above the high. We do in fact have a new range that we're dealing within. So now we're trading higher. We'll see how far this goes. This is crazy. We don't trade Mondays or we don't stream Mondays, and this is a super clean London. Again, just kind of going back to the basic of this chart exercise here is that we're just waiting. You know, we can utilize EQ as a very easy target. Then how do you know you're going to see the other end of the range? Well, when you start to flip EQ, essentially, right? Once you have this range, if you're just following your range simply with a Fibonacci tool, you can start to see how that narrative forms, and then you add on to that whatever else you possibly use or know. You can add in any models for your entry. You can add in your time-based levels. Pick your poison, pick a range, any range, and you put 1, 2, 3 things together, and you start to have a very solid basic foundation of how you can start to navigate price. Swing high formed. Let's see if it's traded through. So swing high, 3 candles, traded through on the 4th candle. In that same instance, we did also shift market structure and print 2 inversions. Pretty strong swing high formed, and you'll also notice here that an institutional swing point was also formed here. So we have that run on stops, which is a breaker formed. Pretty strong swing high to me. We can see EQ on the very aggressive entry could just simply be trading a short as soon as this candle prints. Once the swing high is put in, I would have waited personally for this candle to print and close, but once the swing high is put in, again, that just makes it probable that you can see EQ of the range. All right, no EQ. It continues to trade higher. It traded into the upper quarter of the range, use that as support, and continue to trade higher. We did not see EQ. Just adding clues, right? So here we think, okay, I'm gonna take this entry. We ran buy stops. I'm gonna try to take this trade into EQ. And if I trade this trade into EQ, I want to see follow through. Once we get this entry here, we do have the next candle close lower, but every single candle after that trades higher. And then the worst sign is that we trade fair value, right? We trade fair value. I want to see a close through that. If we don't see that close through, that's a bad sign. We in fact respect this and trade higher once more. Retrace again, not creating a new low, and again we trade higher, fair value, right? So that just kind of tells you that your stop is about to get ran. Also, like if we use these inversions as kind of your last line in the sand, we printed fair value right where this inversion is, and then we close through this inversion here. So all clues that say, okay, we're probably not going to see equilibrium now. We're going to see the other end of the range, or it's going to keep going. So we'll continue to just draw price forward. Another swing high is put in. We've traded below the upper 25% now on a larger scale. So here, what is this time here? 310 to 320-ish. So on the lower time frame, we have this institutional swing point. 310 to 320 is 2 5-minute candles, so we essentially have an up close candle and a down close candle. 310 to 320, 315 closes at 320, right? So we have an up close candle, down close candle. On the higher time frame, this is not an institutional swing point, but on the lower time frame, it is. And then now you saw from me going up is that we ran this high, and now we've closed lower, and we now have an institutional swing point on our higher time frame. I personally like to see that institutional swing point form. I don't like to take it on the single swing. So once the swing high formed, even though the swing high was confirmed trading lower than any one of these 3 candles, I'm not going to take an aggressive entry there. I want to see either a lower low or a higher high, right? So that, a lower high or a higher high to confirm an institutional swing point. This is the 1-minute chart. It prints, and then we run that high one more time on a 5-minute basis, and then we displace lower. So another swing high is put in, fair value established. We're trading below that upper quarter now. Swing lows are now above us. Swing low, just by the connotation, is a discount array, and if we're trading below that, then we are bearish for the time being. And there's EQ. Now here, will we see the other side of the range, or will we continue to trade higher? Okay, so we have that bump in the road. Bearish arrays continue to hold, and we trade lower. We're in the OTE area now. You'll notice here it retraces exactly to that OTE level, that exact OTE level of 0.705, and we wick that nice and proper, and that shoots it up. And so here we run our previous candle lows on that down close candle. Let's see if we get the open of this last down close candle just to kind of add to it. Nope, it misses it. I want to see a close above the swing high. We did already confirm an inversion. We've printed a down close candle above up close candles. All of this are clues to me. We failed to get to the bottom quarter of this dealing range so far that we're dealing within. We close above this high. Now again, when we close above swing highs, we want to see that follow through, and we want to see continuous displacement above. When we have fair value below us, that it's going to retrace into that fair value, but we want to see all these bullish arrays hold. So as soon as we close above it, we have the next candle, we close lower, concerning for that 1 minute, and then we trade into this fair value gap, close above it, trade into it again, close above it. So for these 3 minutes, you're waiting for that continuation and displacement after this candle confirms the breaker structure. On this fourth candle here, it displaced lower, and now we have this inversion, this inversion. We did not get that follow through that we wanted to see. Ideally, I would have liked to take partials there or start to bail on the idea altogether, because we failed to follow through on this close above. Now this could be a nasty run on stops. Once we get to this low, it can run stops again. It can trade higher after that, or this can simply be the silver bullet, you know, or the break lower to see the other side of the range. And I want to remind you that on this last swing here, we did close below this low. And then now what have we done on a larger scale? We ran the stops here, and now we've traded back below that high, right? So on a 5-minute basis, we've done the same thing that I'm explaining on a lower time frame basis. We've ran the high and traded lower. Once I'm in here in this area, if I were to take this trade, then from this swing low to this swing high, that is basically a base hit, or that is very low hanging fruit. So here at this point, I can choose now, if we're not displacing above this high, to break even, to take partials, or to TP altogether. So now that we are unable to displace above this high, run on buy stops could be the case. And we could start to see the other end of this range with the clue that we're not displacing higher. And we did close below this bigger range here. We closed below this low from here, right? So premium, discount, EQ, premium, discount, run the high. Yeah, we missed EQ there. Runs, stops. There happens to be fair value and order flow right at that EQ level. And here we don't run the low. We trade higher. We don't take out the high just yet. We're now negating these this bearish PD array. So we're just staying in this range so far. Every time we get into premium, we come back into discount. All right, we finally break the low. So now we're breaking lows again. We're now at that bottom quarter of this range, right? This one here. So we're at 25% right there. Move our dealing range forward. So this low held. We have our new range, and there is EQ once again. Again, that nasty run on stops that I said was possible. Run, sell stops, and then continue to trade higher. Let me just change this to OTE really quick. So it did dive lower into OTE and then trade higher here. So once we formed this swing and then we had the follow through of the market structure shift, we continue to break highs. Once we form that swing low, the EQ of this range is seen. Now we're still working within this framework. We've gone from discount to premium back to EQ. We had consolidation at EQ. It ran sell stops, and now it's displacing higher. We should now see the opposite end of the range. If this is in fact bullish, uses EQ as support, so as resistance so far. I'm pretty sure, so this is all ranges within ranges now. It's getting crazy as we start to move forward in price. In this instance here, we have this range, premium to discount. We do retrace into EQ here. We're using that as support. That happens to be the bottom quarter of this leg down. So in this leg up, we see EQ. We're probably going to see EQ of this bigger range again. or we can see the opposite end of the range altogether, but we want to see this high be broken above first. Back above EQ, we have a new high. We do. Once we retrace into EQ and we have this new range, we have a new low established and that new high. This would be the dealing range that I'm kind of working in as a framework. Now, obviously, we have many ranges within ranges within ranges. We're overall working within this bigger range. We have the narrative so far that we created this original range to open the week. We ran sell stops, traded to EQ, ran sell stops again, traded to EQ, displaced lower. So the range that we are currently in, just using premium and discount, no other concepts to you for your framework or for you to understand price, literally just a Fibonacci tool. No time-based elements, nothing at all. You're literally just looking at premium and discount. So this is simply price theory, right? We've traded up. We have our bearish leg back down. Now here, for a new range for us to retrace into EQ. Once EQ, because I believe that the market is ran by an algorithm, and the point of the algorithm is to make sure that the market is running efficiently, then I believe that it's going to retrace to inefficiencies to rebalance them, right? So once this range has essentially became efficient, because we've rebalanced EQ of that range at a minimum, I can now start to utilize this range as my new range, as opposed to waiting for EQ of this entire range, the entire range, to see like what happens from there. So until EQ is retraced to, I am using this current range. Once EQ is retraced to, then I will follow that new range. EQ is still holding. We do in fact create that new high. We did retrace to EQ of this range as well. Following price, this is the new low that was established before EQ was all rebalanced. So this is all essentially rebalanced. And now we just follow this range here. We're above EQ of our bigger range. We're above EQ of the parent dealing range that we're in. So kind of still consolidating here. What we want to see for higher prices is we want to see the upper quarter be traded up to. You can even quarter this out. So we want to see these upper quarters traded into. What we're currently seeing now is, okay, so this range EQ met and traded higher. Now we've closed through this altogether. That's what is now our market structure shift on this current time frame. But currently, so far, what we're noticing in this price action, as it just slowly grinds and consolidates, it's consolidating on EQ of our bigger ranges, right? But it's also just running stops. So we get above the high, and then we displace back lower every time we get above the high with these deep retracements until we get a market structure shift. So this right here is what is, you've probably heard before, is what's called high resistance liquidity into these highs. Unable to stay above them, and we continue to displace lower. I want to see from there, do we continue to trade lower or do we continue to trade higher? We've shifted structure here and we have this fair value above us. We did already retrace into equilibrium here for the possible move higher. We did not get that, so I'm going to choose to keep this range here up, simply because we're still dealing within this overall parent range there. We have this next dealing range of our leg down. We retraced into equilibrium of that. Since all of this is efficient, we're unable to stay above EQ of this range. And all of this is made efficient. We have high resistance runs at the high. I do definitely think we'll possibly see this low ran, because if all this is efficient, essentially we would run through it with speed. Of an area of previous consolidation, you'll usually see displacement right through it, versus an area of fair value, you kind of start to fill that fair value in. An example of that would be, like, let's just look at this buy model here. This area of fair value we're kind of filling in. Then this area of consolidation we displaced right through. This area of fair value we have consolidation. This area of consolidation we have fair value. You kind of, when you get to the other side of price, generally you don't want to see these areas of consolidation hold you down. You want to see displacement right through them. So we displace right through here, we get up into this area, have a slight pullback, and then displace right through that as well. So now, you know, on this price leg up, same kind of concept. We have consolidation happening around here, lower time frame consolidation. We displace right through that. Fair value here. We consolidate for a quick second, reaccumulate orders, mitigating that low, and then we trade lower once more. We get to this area consolidation, have a slight retracement, and then displace right through it, consolidate again inside of this area of fair value. Going back to this, because all of this is efficient, I would actually want to see some kind of displacement right through all of that if it is indeed bearish at this point. So we displace through that. We'll do premium and discount of this area right here. We are into EQ. We've made it to the bottom quarter. We have a swing low here. Don't make it into EQ. Fair value there, right at EQ. We've seen this happen earlier in the backtest. Still miss EQ. There we go. So there's EQ there. So once that swing low was established and finally traded through there, above the upper 25% as well in this small range, we do make it to EQ. It seems to be rejecting EQ at the moment. We have a new swing high, and it does displace through this low. Now that we're at the bottom quarter of this bigger range, and we've traded through this range right here and rebalanced it, this is the new range that we're within. Do we see now this low? Again, we've used these levels, or we've used essentially equilibrium as support and resistance. One thing that I kind of want to show you guys here, let me see if I can pull it up quickly or not. I've only ever studied ICT in my career so far. I say all that to say I didn't know what support and resistance was even prior to ICT. I didn't know what a trend line was. I didn't even know what liquidity was. I didn't know any of those like very basic concepts prior to ICT. Started studying ICT in February of 2022. And that happened to be right around the time that he was starting the mentorship. The very first couple of videos that I watched, which is literally him going through and like showing you how to use, I think, TOS at the time. Even all of that was going right over my head. So I was like, dude, what is this? I don't know what this is. So I was like, okay, I don't know any of this. Maybe what I should do is go back and study like his older stuff. Maybe that will help me understand all of this. And that is what I did, and that actually did help me a ton for sure. Support and resistance is very much a part of what he teaches, to be honest, because, you know, an inversion fair value gap is essentially a fair value gap being flipped. A breaker is an order block being flipped, right? So just to keep it super basic, I don't want to insult any ICT students or ICT himself, but you can kind of stick to, like, just to dumb it down as much as possible for a 5-year-old to understand. Okay, so can everyone see this screen? can see this windows here. So this is literally how this is how I learned support and resistance, is through these notes here and like this depiction of price being displayed here. So 1, price fell through support. 2, support becomes resistance. 3, price breaks through resistance, this resistance here, and then resistance becomes support. So this like initial area of, you know, support and resistance here in this consolidation, we break below it, we resist it, we break through it, and then it uses us it gets used as support. Sorry. So I use that concept essentially within that premium and discount range, within the quarters of that range. The very first series that I studied by ICT was the Went series. The very first homework assignment within that Went series is to simply delineate swing highs and swing lows. Okay? And in that swing high or swing lows homework assignment, you are annotating your swing high, right? Again, swing high with a high in the middle, a lower high to the left, a lower high to the right. And you are actually marking out these entire 3 candles, and you're drawing that forward, and you're using this entire range as your swing high, right? And the homework assignment is exactly this. Let me just go up to a higher time frame really quick so that doesn't get too crazy. So you would go through your chart, and I did this for weeks before moving on to the next lesson. So the very first homework assignment that I did for weeks, 4 months, is that I would go in and I would mark this swing high and use the purple for daily. And then, what he says is like you want to make like 1 bold, let's say, for the highs, and then you want to make the lows like another, you know, low like that, so you know which one is the swing high and which one is the low of that swing. Sorry, it's actually this low right here. So swing highs, right? And then you're going to go also through and you're going to mark your swing lows. And swing high here, I'll bold this, and just using like literally this example, right? So as you do this and you start to put a bunch of lines on your charts, you basically get a bunch of levels that price can react around, right? And then I know everyone's like, oh, if you put a bunch of lines on your chart, it's bound to hit one of them. Yeah, I get that. But what you actually learn is that these ranges in which these swing lows form, right? You have other swings forming inside of those swings, these bigger swings, right? And it's not just like as simple as the high, or you know, the high or the low. You literally have price action interacting within this entire range, essentially, right? And then on a much like smaller scale, like if we zoom out of this area here and we go, let's go to an hourly, you have like levels from, let's go all the way back if I can. Once you get like, let's say you've reclaimed essentially this swing low, you can anticipate that we're probably going to either, you know, see an overall bigger swing point here. You're going to see possibly even consolidation, or you're going to trade into that next level, right? And as you kind of go through and you do this enough, you're able to filter out what swing highs are almost irrelevant because they're forming within a swing high that occurred way back here, or a swing low that occurred way back here. So you know, like let's say this swing high right here, this swing high is irrelevant to me because we're still within this swing high. And what is that? In other words, you have a dealing range within a dealing range, right? So hopefully that brings it full circle, and that's why I used the confirmation of the swing highs to tell me when I'm going to see the equilibrium of the range, or possibly see the equilibrium of the range. It's simply because, you know, that doing that homework assignment over and over and over again, you kind of start to see, you can filter out at that point what levels become irrelevant because it's already, you know, within a bigger swing high that you've already annotated, or, you know, in other words, a bigger dealing range. Thank you, Cozy. You're in another dealing range, so then it's like, okay, I don't have to refer to this price action, right? And I kind of showed you why I wouldn't on a much smaller scale, just using the same exact concept. But then now I also have, like, between this swing high and this swing low, this is my dealing range, right? Going back to that homework assignment. So that's kind of why I do it that way. Like, I want to see that swing high. Until, if we're just continuing to print candles up and up and up, and we're continuing to make new highs, let's say on the 5-minute basis, like this, although I am following it to see where that premium and discount is in real time, because as we saw at the beginning of the session here, on literally when the market opened, this dealing range right here, this one candle already retraced into premium. So when I started printing the candles and we got there, as soon as this candle printed, it retraced into premium, and I was like, okay, we already have this as being efficient. And then what did we see through that? We saw speed through that area, right? So again, kind of bring it back to where we were. Here, I'm following price in its current dealing range, and I'm keeping it up to see that, you know, if we possibly get that one candle rebalance, I know that it already happened, but I'm not thinking that price is going to come back until that swing low is put in, until it's actually established. And the confirmation, because you can print swing lows and swing highs, as you can see, especially on a lower time frame or a 1-minute basis, you can print them all day, right? But how do you know it's actually going to go back to EQ? To me, I wait for that fourth candle to trade through those swing highs, again going back to that homework assignment. And then what am I looking for as you know, around these swing highs, or what am I looking for once that swing high prints? I'm seeing, okay, where did it print? Did it print possibly under the range of another bigger swing high, or did it print at these levels that I'm referring to within my dealing range? Did it print above these highs and then, you know, displace lower, below lows and then displace higher? Or are we printing highs below lows? Are we printing lows above highs? And essentially, again, not to insult ICT, but just to dumb it down, you have effectively support and resistance. Okay, it continues to displace lower. Again, I do think, you know, obviously from here, I thought we could possibly see the opposite end of the range now, because we were so high resistance above these highs. And swing low is formed, but not yet confirmed. We trade through, nope, we don't close above it, we just trade through it. We do close above this candle here. It's possible that we go back to EQ before we take the low. We get back up to the bottom 25%. All right, and then we do see that continuation down past these lows, right? So now we're within that new dealing range. We've once again closed below a low. So on a higher time frame, we're breaking lows. So we have this range here that we're now within. We know that all of this was made efficient. I can opt now to just use this range, right? We have not retraced to EQ yet, and we've already worked our way out of this range here, but I know that this has already been rebalanced, so I can just choose to operate here. Again, I'm not trying to like teach anyone anything new here. This is a simple chart exercise to see what you can do with just knowing where premium and discount is, how you can build a narrative around that, and how effective just knowing where your premium and discount is can be for you in building that narrative. So you'll notice at every point of, or at points in this simple premium and discount, you have consolidation happening at EQ of this range. You have consolidation happening at the bottom quarter of this range. Remember I mentioned too at one point that when you have speed through any like equilibrium specifically, but what is 25%? It's EQ of your upper range, right? And what's 75%? It's EQ of your lower range. But when you have speed through these areas, that's usually a sign that you're going to see the next level essentially. Another thing like for here, this is explained in ICT's algorithmic change in state of delivery videos, but once you see fair value, right, through your dealing range pulled up, let's say up until this point, you actually want to see this left open if you think price is going to continue, because, or well, let's see. Yeah, sorry. If we're up at this point, we don't anticipate that price may come back to EQ here when you have this fair value here, because you actually want to see that get left open to kind of project that range forward. There's a way that I sort of use this to predict price, where I've this is experimental, this has not been at all established. If ICT has taught this in a later series or even recently, I don't know of it yet. But what I've done before is, like, if I see fair value printing, I will actually draw the fib. Let's say I go back to, let's see where we're at, 803. So let's say we go back to here. If I think that price at this point, right, I said I think price is going to continue down to here, what I'll do is I'll actually draw this fib. Let me delete this one. I'll draw this fib past this with the EQ here. I'll put that actually at that swing low. If I want to see this fair value gap get left open around EQ, and I want to project how far my range could possibly go, I would leave that fair value gap open around EQ. Now, where you put your EQ around this candle is up to you. I like to use the swing low because this in itself was its own range. You can also, to be conservative, you can simply put that order flow right there, right underneath of EQ, to leave that open right above EQ. And why? Because at this point we've retraced into EQ and used that as resistance. So this is again just experimental. This is kind of what I've used in the past to see, like, okay, how far can this possible level project forward if this is in fact displacement and we're going to see the other side. So let's go back to where we... Yes, exactly. And then 100%. So again, obviously later in my studies, I was like, oh, that's what it is. once he taught the measuring gap, I was like, fantastic. Like, and so that's kind of like a measuring stick that I use for my own studies, or just kind of, let's say, my understanding and price. Once I start to discover that other people have discovered sort of the same concept, or they've internalized it another way, or ICT confirms it in another type of lesson and whatnot, that to me tells me, okay, I'm not hallucinating. I'm actually seeing these things happen in real time. They're playing out, and that's how I can say, like, okay, this seems to be solid, and I can kind of run with this and test this just a little bit more. Okay, this is our dealing range. We have that swing low put in. Now from here to here, we can see a stop on, or sorry, yeah, we can see a run on stops here, and then it can turn around and go lower, or if we are able to break above here, then we can likely see EQ. So we get above that 25%, we shift structure. Now we're above that swing high and we're moving through all of this with speed. We want to see follow through. We do get EQ now. Still all speed so far. Because of the time of the day, and again, I don't want to add on concepts here, I really just want to keep it to framework based on premium and discount. But because of this time of day here, 7 o'clock is the 4-hour open. Yes, 7. It's the 4-hour open for DXY, right? So 7:30 is actually where ICT teaches OTE originally. If you go back to study his OTE series, you see expansion from 7 o'clock. You see a run on stops. You see expansion up. Once you get this expansion at 7 or around 7, you draw OTE and you wait for that to happen. Now, it's simply from dollar, a currency, opening that 4-hour candle at 7. So you want to see power of 3, open high low close, or open low high close. If you think it's going to trade in one direction or the other, and then you can draw your fib to see like where that's going to happen. Now there's an exercise that ICT does to say, okay, where does OTE happen here? I want to remind you what has happened so far in price up to now. We've had Asia range consolidation. We had a London low put in. We ran buy stops, and then we ran that London low as well in New York. So now we're at 7:30 to 8. Do you possibly see an OTE on the screen? If I think that we put in low of day, because we're simply on a higher time frame, all we've done is run stops, trade higher, run stops, trade higher. We did close below here, and we did in fact close below right here. And on a higher time frame scale, what does this look like to everyone? 1, 2, 3. I would anticipate here that OTE is right there. This little tiny expansion right there. As we start to trade higher, OTE is right there. Speed all the way up into equilibrium. That was like possibly the only entry, the only possible like logical entry to get into. With that, you obviously had coupled your inversion and the fair value gap, plus a rejection block and order flow, right? So we retrace here. I don't know if you guys all saw that. It did come back into discount. It did come back into equilibrium. It came right into, once again, the actual OTE level, 0.705, not 62. 62 is a universal retracement level for the entire trading industry. 0.705 is the actual optimal entry that ICT coined and got famous for. Yeah, so that area right there, if you just want to demand just a little bit more, this right here is the OTE. So speed, this is the move that you would have anticipated from that 7 o'clock OTE range. Usually now, since we have fair value around EQ, I do want to see this reach the other side. But if you were someone that aims for low-hanging fruit, you've achieved your EQ. As someone that trades external to internal ranges, or try as much as I can to trade external to internal ranges, that would have been plenty for me personally. So then, let's actually keep midnight up for soy. It's been a target every single swing low so far. Alright, so now, we have speed through this, honestly, at this point, because we have that classic, like, OTE low in New York, and indicating, like, a possible, New York reversal. We're probably going to see midnight and the high of the range from here. But we just want to see, like, confirmation. I'm going to remove this here. So because we've retraced into OTE here, again, if you're opting to use efficient ranges, you don't have to. You can just you can keep it super simple, and you can just use your literal lowest low to your highest high as your dealing range. I will say you will probably sometimes miss trades, but again, echoing this from earlier today, using premium and discount, literally just premium and discount alone, no other concepts, you always have another trade on the way. Then you add other concepts to that, you absolutely have another trade on the way. So no EQ yet. We do create a new high. We are failing to displace above this high so far, but we are staying above EQ of this parent range so far. And we have order flow established at EQ coupled with fair value previously. There's our EQ there. Tap to the tick. We are up to the 75% point now. EQ again. We have the new low here. I'm gonna just follow it with the fib. Okay, we opened obviously. So then 9:30 open, we shot straight up to midnight. That was actually gorgeous. Why am I not trading Mondays? Okay, so lesson for me today was I should trade London during New York. This was actually, and then if you follow the range all the way up, this right here was a retracement into EQ before it shot up. Yeah, that was actually insane. And then right to midnight. Okay, so I've been on since 1:30. I think all of you guys get the gist now for the most part. If anyone joined late, I'd be glad to go over more examples if you wish. But this has now been a 3-hour session, and I do want to keep the video fairly short for people who plan to watch this later.